If you clicked on this video because you're a tradie that invests in property or is looking to invest and you have no idea what the new budget means for you, then you're in the right place. We're cutting through all the noise and breaking down the 3 big changes: negative gearing, capital gains, and your borrowing capacity, and exactly how it affects you as a tradie. Plus, we'll run through what the mainstream media isn't telling you about this budget. Welcome back. You're on site with the Property Tradies and Brodie. We've had a huge change to property investing as a whole this past week. Some massive tax changes. What do you think about what is happening currently?
Yeah, there's so much going on.
Yeah.
Speculation, hearsay being thrown around everywhere. Everyone's got an opinion.
Yeah.
And so it's only right if we have an opinion because ours is the only one that matters.
Exactly right.
Yeah, we're going to dive into kind of the thicker things. People are getting really scared on how to move forward. And fair enough, because what's going on in the media is doom and gloom.
Yep.
But it's not all doom and gloom. There are ways around it, and we're here to show that.
Correct. And there's so many changes and little intricacies. So we're going to break it all down, go through our opinions, and also, I guess, where we see the biggest impacts on tradies that are investing in the market at the moment. So some of the key things, I guess, are going to be the negative gearing, capital gains tax, and also the borrowing capacity changes.
Yep.
And where we're going to have to look to pivot for certain investors and where we see most of the market moving.
Yeah, a lot to get into. Really important topics to cover, and I'm sure everyone is just keen for us to get stuck into it.
All right, let's get into number 1 then. So negative gearing. So if you don't know what negative gearing was, basically in the past, if a property cost you, let's say, $10,000 per year to hold, you could then write that $10,000 off on tax if the property was bought in your personal name and not in a company.
Yep.
And if you were taxed at, say, 37%, if you were earning around $150,000 per year, you would have got about $3,500 back on tax.
And so just to clarify, that's coming off your personal income.
Correct.
Yep.
So you earn an income, just like writing off tools or anything come tax time. The investment property was considered as a tax write-off as well.
Yep.
That has now been slashed, gone. Anyone buying a property here on in, you will only get the negative gearing up till July 2027.
Okay.
And then from then onwards, you're not going to be able to claim it at all. But if you bought before the 12th of May, 2026.
That famous announcement.
That famous budget night, you get to keep the negative gearing benefits forever.
Okay, so just so I've got this clear, I own a couple of properties.
Yep.
I'm going to be able to keep my negative gearing benefits.
Correct.
But if I bought a property today, which is post that announcement, I'm only going to get negative gearing up until July 1st, 2027.
Yep.
After that, we've lost all negative gearing.
Lost it. So when they're trying to tackle generational inequality, it's really funny how the people that have all the benefits currently get to keep them, but then the new generation and the younger people trying to get ahead don't get the same option.
Yeah, I've heard a lot of people saying this, and I have to agree. If they really did want to tackle intergenerational inequality, they would have just scrapped it, the full thing.
Yep.
If they really wanted to. But you know what? The people making the policies, they have investment properties too.
Yeah.
And they like the benefits of negative gearing. Correct. So yeah, that's just something we got to think outside the box, because yes, they're making these policies for the younger generation.
Yeah.
Supposedly. But they're also benefiting themselves also.
Exactly right. I think it's bullshit, really, because you're taking away a vehicle that young Australians have been able to use that want to get ahead, which I think is the clear indication here. We're helping young Australians that want to get ahead, giving them a chance to be able to get into the market. For us, it's something that helped us originally get in, and it's sad to see friends, family, or other siblings or relatives that won't be able to get the same benefits, and it's going to make it much harder for them to get into the market.
Well, that's a thought I've been having. Like, who does this actually help? Does it help the people who were busting their ass trying to get ahead, or is it help people who always kind of had that negative mindset that they were never going to be able to get ahead anyway,
Yep.
and that the system's against them,
Mhm.
and that, okay, yay, now the system's breaking and we finally have a chance. I don't know, like you and I were able to do it. Like we lived at home.
Mhm.
We have friends who were able to do it. It was such a great stepping stone to actually getting ahead.
Yep.
I don't know. I personally just think, like you said, it's a load of shit.
Yeah, 100%. So I guess with those key changes, it's going to be super important, and where a lot of investors already we're starting to see move is having a bigger focus on properties that are closer to paying for themselves. Also on that as well, when I don't think we're going to see a price drop at all, because people that are currently using the negative gearing as a tax write-off, the higher income earners, they're not going to sell their properties. Even me looking at my portfolio personally, I was looking to sell an asset in Perth next year, and instantly my brain goes to thinking, well, maybe I'll just hold on to this because I have these benefits which I'll never get to use again.
Yeah, you're exactly right. So the government's their thought behind this whole policy change was, okay, where we might not be able to have previous investors sell down because, like you said, they're not going to. They're going to hold on to those benefits.
Correct.
But their hope is to stop new investors from coming into the market. Hopefully, in their estimate, allowing for more properties for young people to buy.
Yep.
That's going to be, I think, a rude awakening to them, because if smart investors will always find a way to get into the market and grow wealth through property. And also there's just going to be more pressure on that lower tier market now,
Correct.
which we're going to dive into a second. There's going to be so much more extra pressure on that lower tier market that the same people that they're trying to help, it's just going to backfire on them.
100%. 100%. Cool. So that's the negative gearing changes. Fairly straightforward for the most part. The only other thing we need to touch on is it's not actually completely gone. When you go to sell a property, or if the property starts to turn a profit, this is where it might get a little intricate, but you're able to then use that negative gearing. So let me break it down. If you, over 10 years, you have a property that grows by $200,000, and let's say the property costs you $100,000 over that 10 years to hold. When you go to sell the property, you can then take off the $100,000 that it cost you to hold that property from the tax you would pay on the sale. Okay. So to break it down, rather than you paying tax on the $200,000 gain, you take that $100,000 off and you only pay on that $100,000 gain.
Yeah. So in other words, and just from a different angle, because it is a hard concept to wrap your head around. So we'll try to explain it in a few different ways. But you were previously allowed to take that loss and claim it against that tax time against your personal income.
Each year.
Where now you're not able to do that anymore. But you can claim that loss against future gains on the property, and those gains being rental income coming in.
So either sale or rental income.
Yep.
So if the property then for the next 10 years pays you $100,000 in positive income, you would not pay any tax on that, because that loss is then counteracting that now profit.
Yeah. So the new kind of game plan is to get properties that aren't going to be negatively geared forever. You want them to become at least positively geared in a shorter time frame than what you probably would have.
Yes.
So that you can reap those new rewards or those benefits now.
Correct. It's definitely going to push more investors down that route, but I think this is where people can get lost in all these changes. The crux of property investing is still the capital growth.
100%.
So it's finding the best capital growth possible. That's always going to be number one. And then from there, it's working around the tactics that are able to aid in the cash flow side of things, which we will touch on the strategy a little bit later.
Sounds good.
So hopefully that covers everything in negative gearing. I think we touched on everything there. Let's get into change number 2, which is the capital gains tax. Again, they're not making this easy for the average person to understand, because even us, Brodie, being in the industry and dealing with this stuff every day, it's fairly complicated.
Yeah, 100%.
What they've put forward.
I think they do that by design.
100%. To confuse people, and it's much easier to say, oh, this is too hard, we're just going to have a negative outlook. It's all shit.
Yeah, 100%. So it does. Let's just spend 5-10 minutes wrapping our heads around it and understanding how we can approach it in this new scenario, in this new world that we're living in, and then how we can actually like benefit ourselves and our investing.
100%. So the capital gains tax. So let's try to run through this. So previously, if you owned a property and you held that property for over a year, let's say you sold the property for $100,000 gain, instantly they would say, because you held this investment property for over a year, you only have to pay tax on half of that profit. So instantly, out of that 100,000, 50,000 you keep to the side, which is totally tax free. And then you would have to pay tax on that 50,000.
Cool. So quick recap: you made 100K in the sale. That's profit. You're only going to get taxed on half of that profit. So you're getting taxed on 50,000.
Correct. Cool. And how that would have previously worked is this would be added to your yearly income. So if you earn $100,000, you've now earned 150,000 per year. And that would then be taxed at whatever bracket tax rate that $50,000 falls into.
Gotcha. Okay.
And
fantastic.
And now what's changed is they've totally got rid of that on established properties.
Okay.
It applies on new builds. So they're trying to push investors down building new properties. And we'll touch into why that's a recipe for disaster later on. But the new rules are that the government will take into account inflation. So you get no tax discount, but let's say you make that $100,000. Over the last 10 years, the inflation rate has averaged at about 3% per year. So anything you make on top of that 3%, you pay tax on.
Yeah, so it can definitely get confusing, but it's not as terrible as it sounds. Right? It isn't. So just to really dumb it down, say for example, 100% of the property, right? You've purchased, you sold a property, 100% of the sale. You're going to take that 3% off the 100%, and you're now getting taxed on the 97%.
Yeah, for each year that you hold that
each year that you hold it.
So
right. So the government is actually trying to play nice ball here and say, hey, we understand that you're selling the property later down the line. We're going to make sure that we remove however much the inflation has affected that asset.
Yeah, honestly, I think this is more of a bullshit rule that says, because the thing is the government lies about the inflation figures and the amount of weight that they put on certain metrics changes year on year to make them look better. So as far as trusting them to put the right inflation figures out, we all know the last few years what they've reported compared to what it actually is.
Definitely.
Is a load of shit. But
they also didn't have to put it in there. So
correct.
I wouldn't have put it past this government leaving it out.
Correct.
So we'll take the small win.
Yeah. So at the end of the day, if you beat inflation by a lot, you'll pay more tax.
You're still going to pay a lot.
If you barely beat inflation, you won't pay as much tax.
So maybe the shit investors get the win here. The good investors still got to pay the government.
Correct. as usual. But again, just honing back on people making a huge deal out of this. I'd much rather make a higher profit 100%. And pay more tax than make fuck all.
No doubt.
So that's where you need to understand that investing, the philosophy doesn't change. It's just the outcome that is going to be slightly different. But yes, the new builds, that's an interesting one.
So the government, their aim here is, because there's a supply issue, this is kind of their solution, is we're going to make it harder or make it less incentivized for people to buy established. And we're going to try to incentivize them to build new homes, which adds to supply and helps the housing crisis. But does it actually help investors get ahead?
Well, a few key main points here. As far as helping investors get ahead, no, because where I see this going really bad is, for starters, the amount of tax the government takes on new builds is like 50% of the total build value. So when people think, oh, the government's helping us out here, this is just them moving things around and portraying it in a certain way for them to take more tax. That's why new builds in Australia cost so much. for investors, this is going to ruin a lot of mum and dad investors in the future, because the average person is going to go down the house and land package route. And what you're going to find is new suburbs being built where 80% of the owners are going to be investors.
Yep.
You're going to build whole suburbs over the fact that you have everyone in that area renting.
Mm-hmm.
That's not going to be a desirable place for people to live, and it's not
Definitely
going to
not.
bring capital growth in the future.
100%.
And this goes back exactly to what I was saying before. If you're investing for a tax outcome, then you're going to do poorly.
Mm-hmm. Yeah, and we want to be investing for the long term. We want to make sure that the places we're investing in are actually appealing to the people that want to live there, like you said. And they got to have the foundations to actually grow in value, because we say this all the time. It's important, the property that you buy, but the suburb does the heavy lifting,
100%.
or the area does the heavy lifting. So if you're building in a suburb or an area that has absolutely no infrastructure yet, how do you expect that property to grow in value?
Yeah. And not even that, how can you make any sort of assumption or informed decision on what this suburb will look like in 10 years' time?
100%.
And on top of that, I think we're going to see property developers, they can smell blood in the water here. And you should know, when there's demand, obviously, this is when prices go up. So property developers are going to start just shooting up prices on new builds. The amount of emails going out to people, professionals within the industry now are going to be substantial, because it's a much easier selling point for people. So their commissions will go up, build prices will go up, and it's going to be that mum and dad investor that get burnt.
Yeah, I'm going to look down the barrel of the camera here and say this is a PSA, a public service announcement.
Yep.
There will be property spruikers and developers that will come, and they'll try to sell you the dream that you'll be able to get depreciation and all the benefits and all this, but you have to think long term when we're investing in property, and just brush them off. Brush them off. They're all fuckwits anyway, so don't listen to them.
Yeah, this is where I see the biggest, I guess, the scariest change within the industry, because you just know how this is going to play out. It's clear as day. This is the change which I really dislike the most, because there's no planning behind it from the government, and it's going to be a free-for-all from here.
Yeah, just educate yourself, guys, or at least speak to multiple people. If you are feeling like that's an option for you, just speak to someone else on the other side of the fence and just weigh up your options.
Exactly right. But again, from our perspective, we will not be going on to new house and land packages.
Definitely not.
The only where I see the industry potentially changing slightly is in built out areas where there might be small parcels of land. So let's say you've got an area, a suburb that might have 95% of the area built out, and all of the surrounding suburbs are also built out. There can be some decent opportunity, if you're not paying way overs for the build price, for you to still get those benefits that you do with a new build, but still getting into an area where we understand the metrics behind the location.
Yeah, it's a very minuscule, very small situation that might niche. That's what I'm looking for. That you might find works, but just to save yourself the hassle, go with what actually works.
100%. Yeah, risk minimization at all costs. All right, so that's the first two big changes. The third one, which I want to get into, is the borrowing capacity impact of this. So to give some background on what we're going to run through here, basically in the past, you could go to a bank, and when you get your borrowing capacity, so borrowing capacity is the amount a bank will lend you to purchase a property, they would take into account the negative gearing benefits, and that would then mean you could borrow more money. Now, what we're seeing is, with those negative gearing benefits being removed, this is now dropping the borrowing capacity for investors. Little story, we're working with a mortgage broker helping him purchase a property, and he was telling us how 3 of his clients that were pre-approved and under contract for $1 million then had their borrowing capacities drop to $700,000 each. So a 30% drop in borrowing capacities. it's probably going to sit anywhere from 20 to 30%.
Yeah, that's massive. Like we really need to hone in on how important borrowing capacity is when the banks actually factor in the negative gearing aspects. And now that they're not factoring that in, you're going to be able to borrow less, which means you're buying a house that's worth less, and you might have to fully change up the strategy. It's it makes a big difference. Funnily enough, I was actually on the ABC, and this was my
Big ABC guy.
big ABC guys. If you can't tell, anyway, I'm infiltrating them, guys. Don't worry about
hopefully.
it. I was on the ABC News, and they were interviewing me on this exact topic: how the borrowing capacity is affecting young rent investors. And I pretty much said, yourself and myself, that's how we were able to get into the market.
Definitely.
Is because we were actually able to borrow that bit more. It like pushed us over the edge to get in. Now young investors don't have that.
Exactly right. And it really, it makes the deposit that you need to save larger. And then when you combine that in with the fact that you're grandfathering the negative gearing and you're making the people that owned previously not sell, well, it's not going to drop prices, is it?
No, sir.
No,
sir.
So what you got now is you're reducing the borrowing capacity for young investors that maybe can't afford the areas that they live in. You're now pushing them into asset types such as apartments, and you're also likely increasing rents at the same time. So if you're out renting and you're trying to save to get into the market, well, they've just smashed you on both ends.
Yeah, and look, I don't know if we are going to touch on this before, but I think it's an important one to bring in. So those mum and dad investors who initially had the higher borrowing capacity, it's now been hit. They've been moved down to the lower end of the market. And who is that competing with? The same young first home buyers that they're trying to get into the market.
Exactly right. So you've now pushed so much demand into the lower end of the market. You've reduced borrowing capacities for the average person, pushing them into these lower price assets. You've now also got, which has been in place for 6 months, the first home buyers grant, which has already pushed the lower end of the market. So basically, you're taking that whole bottom end and you're lifting it up massively, and then you're probably shrinking the gap from the top end down a little bit because you're taking away the amount of people that can purchase investment properties at that price. Again, for the most part, investors do typically stick to more affordable prices, but you are still removing demand from that higher end investment product.
Yeah, anyone who thought that property prices will stop growing, you're kidding yourself.
All right, well, let's get into our key takeaways from these changes, where we think the market will go and where we're pivoting to personally and for clients as far as asset selection. Let's get into it. So we've already touched on, I guess, the current investors are not going to sell their negatively geared properties.
No.
They're going to hold on to them forever. And that's not going to drop the prices of the current market. It's more just probably going to stem the demand for properties that are negatively geared a higher amount, I would say.
There's definitely not going to be any extra stock coming to the market. There's just going to be a little less competition. And so you might be able to snag a deal or two if you're an investor, if you're a smart investor. But I don't think it's going to play out the way they want it to play out.
And keep in mind, what I think is going to happen is over the next year or two, we're going to see rents increase to make up the difference that you would have got back in negative gearing anyway.
That's a really important note. They claim that rents will only grow by like $2 a day, $2 a week, like something absolutely
bear me.
Stupid. Guys, simple mathematics, right? It's supply and demand. If there are less rental properties available, then there's going to be a higher, people are going to charge more on their rents just because there's less available, right?
And not just that, but it's also a mindset thing. If you're an investor and you've got an investment in the market, right? And you're going to instantly think now, okay, each time when there's a rent renewal, we're going to put it up to the max price if you're buying in and you don't have those negative gearing benefits. So I think it also changes the mindset, which again, also pushes up prices because at the end of the day, the investor does set that rental price.
Well said.
The lower end of the market is going to boom. It already is. But key thing is also certain asset types that might not have been as strong a proposition in the past are now going to be in heavy demand, and we're already seeing this shift. So where do you see this going?
Yeah. Well, I've personally seen it on the ground.
Yep.
And from people I've spoken to and other buyers agents similar to ourselves,
Yep.
there is a shift to higher yielding assets.
Mm-hmm.
We've spoken I've spoken to other people about higher yielding apartments,
Yep.
specifically the smaller density ones, just because they have a better land component.
Correct.
And then properties that have uplift potential or maybe room for a granny flat out the back.
Yep.
They are where people are shifting more of a focus to combat the new rules and regs that have come in.
100%. So I think this is really going to increase the value of those two particular assets that you just mentioned, right? Those high yielding apartments. I think this is going to boost the whole market as a whole.
Yep.
But as investors, we don't want to be buying in high rises, and we want to still stick to the fundamentals. So the focus for us, for clients,
and our clients,
and personally, is going to be on those smaller apartment blocks, especially in Melbourne, where prices haven't grown in 10 years. Building approvals on these assets are super low. It means we're likely going to see capital growth and cash flow at the same time, which is exactly what we want as investors. And then with that second asset type that you mentioned, I think it's going to raise the prices on properties that can be developed, and also ones that have granny flat potential, because you're now
there's a premium for them now.
Yeah, those investors that have had, are sitting at that higher end, that are still looking to buy investment properties, they're going to have to be a bit more active.
Yeah.
And that is from either developing a second dwelling or building a granny flat. So if there's more demand for that type of asset, then prices will probably go up with it.
Yep. Okay, cool.
So next one,
we did talk about the property developers smelling blood.
Yeah.
Yeah, look, I kind of gave my opinion down the barrel of the camera, but guys, just be careful. That's my biggest thing, and just get second opinions. Just don't get sucked in, because they're salesmen at the end of the day.
Yep.
They're sleazy, they're salesmen, they'll sell you the dream. Just be vigilant.
100%. Also, I think a key thing and a bit of a recommendation, I'll definitely be doing it on my end, is we're likely to see investors that are going to be drawing down on equity to use rather than selling. If you buy in a market where the amount of growth has been substantially higher than the inflation rate, and if you do the calculations on how much tax you'll pay when you'll sell, I think that's going to hold people back from selling, and they're going to look to use their equity more. Important to note, when you do withdraw equity from a property, which is the growth, you do have to pay interest on that.
Yeah, it's a great point. People are going to find creative ways to get around this new CGT taxation that they're doing. And yeah, that's one that I'm sure we'll be doing, is holding on to the quality assets that we have and just drawing from them instead of selling, because it's going to be more beneficial doing it that way. Things change and we have to adapt. That's one way of doing it.
Definitely. Self-managed super funds are going to see a huge uptick, and a lot of investors are going to move to this investing strategy or vehicle, however you want to look at it. But basically, with these new changes, it has not impacted how self-managed super funds work. So if you purchase a property in your super, and you take that asset into retirement age, whatever that is, 65, 67, I don't know the exact age, this property will then be tax-free come that time, and any income you're earning also tax-free. So as far as a long-term vehicle to create wealth and maximize your tax benefits, super is going to see a massive rise. I think this is really good for the mum and dad investor.
Yes.
And if I was to look at things and, it would be focusing on those houses that are set and forget, because they're still going to be the best long-term performers, having those assets in your super, and then in your personal name, being a bit more of an active investor, focusing on building a granny flat, possibly buying those apartments, is where I see the new strategy going down.
Yeah. I don't really have any more to touch on that. I know we didn't really speak about SMSFs throughout the start of the video,
Yep.
but you killed it there. They are still a great vehicle to buy property in. And like you said, mum and dad investors who have cash sitting in their SMSF and they're not doing much with it,
Yep.
it's definitely something to look into.
100%. So, yeah, self-managed super funds. I think we're just going to see that grow more and more. And for established properties, this, especially in the higher end, this is going to be the vehicle that investors look to. High yielding investments will shine. We have gone through that. And also the idea that this helps generational inequality, I think, is a load of shit.
Yeah, I second that. And anyone who believes what's coming out of the government's mouth right now, I think you just got to listen to us a bit more.
Yeah, it's just it's just a way to take more tax and to sell to younger voters that they're doing something. And by adding such a complex, so many complex scenarios to these changes, it means that the average person would just look at it, read the headlines, and not dive into how this is actually all working and take it for face value, which you should never do.
Personally, I think we are able to speak on this particular topic probably better than anyone else. We're both pretty young.
Yep.
We're both able to get ahead with the way and the formula that they're saying is broken.
Yeah.
So like if we were able to do it,
Yeah.
anyone was able to do it.
Yeah.
So it's just an excuse, like you said, to do a tax grab.
It's fucking sad because, if we were a few years younger and we were looking to get into the market, we wouldn't have these benefits and we wouldn't be in the position we are today without it. So it allows the rich that are handed down money and all the knowledge to get richer, and it makes the average person that might not have come from money, it's a lot harder for you to get ahead.
Yeah, I think it is important to mention because, yes, it is a lot harder to get ahead. And I don't want to harp on this too long, but it's still not impossible to get ahead.
Correct.
There are ways to get ahead. We've spoken about them,
sure.
and we help clients all the time.
Yeah.
And have so many calls booked in to run these new strategies that we've got on.
Exactly.
It's not impossible. It's just a change.
Yep. The goalposts have changed, most certainly. All right, let's get into our favorite segment and then the men's finance questions.
Let's go.
Brodie. So if you're new to this segment, Facebook group called Men's Finance, and a lot of people put up their questions about investing or finances in general, and I like to pick out two of them and run through them. So first one from Anonymous seems to be a weekly messenger. He has written, so what is the strategy now on getting ahead? Is it possible to still rent vest? Is a trust still an option? Seem like a solid plan for a lower income earner to buy some growth assets, bank the profits, and eventually roll it into a PPOR or home in 7 to 10 years' time.
Yeah, first and foremost, it was a solid plan. It still is a solid plan to an extent. Once again, the goalposts have changed. This obviously isn't financial advice. I'm not going to touch on the whole trust side of things.
Yeah.
I would suggest speaking to an accountant, a property accountant, getting their opinion on it.
And what I would say now is having a good quality accountant on your team is even more important
than ever.
More important than ever, especially if you have a business or you're looking to build a larger portfolio.
Yeah, cool. So what's the strategy now on getting ahead? It is going to be, well, there's a couple different. Our one would be assets that just have that little bit better yield so that you can service the loan a bit better, and you might have to go into a cheaper asset. That's fine. But those cheaper assets with great yield, they're still going to grow, especially in the condition that the market's in right now. It's still red hot. You might find other people buying their PPOR first and then renting it out and getting that 6-year rule. That's the other one that I see some people doing.
Yeah, so either going into your home or just focusing on different assets. And is it still possible to rent vest? It definitely is. The benefits from getting negative gearing aren't there as much. But again, we're investing for capital growth. So if you're purchasing in your home state and that's already doubled in price over the last 5 years, you might live in Perth now. Well, rent vesting still makes sense because the goal here is to build wealth. And as we said, a lot of people are going to move down the route of buying their home first to get those tax breaks. So if you are doing that, it's very important to have an understanding of the market you're buying in.
Yeah. And if you don't have an understanding, speak to someone who does.
Definitely.
All right, I got a question for you. This one's from Mitch in Men's Finance Advice.
Yeah.
Hi all, I've just surpassed $100,000 in savings, and I'm 24. As the new Oz budget has just dropped, the question is, would I be better off putting deposits down on two houses and renting them out, or just stick to one? I'm not in a rush to make this decision. I'm fortunate enough to still live with my parents, so I'm going to continue to save for the next few years. Just trying to get a plan and see what others think. Thanks for the advice.
Awesome. Let's tackle this one then. So 100K, Mitch, at 24. That's awesome. Good stuff. Um, you definitely wouldn't have two deposits for houses with 100 grand. So definitely sticking to the one asset for now. And then I think a really key point here is that he's still living at home. So living at home and investing is now going to be even more beneficial because of the extra lending you're going to get from that as well.
Yep.
When the negative gearing is now gone. So what I would say is stay living at home and then just use that to buy one asset. If you're looking to build your wealth a little bit quicker, find something that you could potentially add value or build a granny flat on, as you're not going to have those negative gearing benefits, or focus on that higher yielding asset.
Yeah, the first thing that stood out to me with this was that he thought he could buy two properties
Yeah.
with 100K saved. So that tells me that you probably haven't spoken to a mortgage broker,
Yeah.
Mitch. So that would be the first step. Just speak to a property savvy mortgage broker. Take it from there.
Definitely. All right, rapid fire questions. Let's get into it, Brodie. I'll ask you 5. You ask me 5.
Ooh.
If I already own an investment property, do I need to do anything right now?
No, everything stays status quo unless you're looking at investing further, then maybe get refinance. But no, you don't have to do anything right now if you own an investment property.
Nope. So all the tax changes are the same. Don't go and sell because of the headlines.
Great point. Don't sell, guys.
Yeah. Does this change make property investing not worth it anymore?
Definitely not. No, we stick to the same goal. Like I said, goalposts have been moved, but property is still the best vehicle we have in Australia to get ahead
Yep.
because we're still leveraging money that is announced from the bank. So no, it hasn't changed. We just got to change with the new rules.
Yeah. Should I be rushing to buy a property before 1st of July 2027?
No, it doesn't make a difference whether you buy now or buy before July 2027. It just means you're going to get like a little bit of negative gearing for that time period up
Yep.
until July 2027. So no, never rush buying a property ever. Make sure you do your research and buy when it's right for you.
Yep. Will rents go up because of the new tax changes?
Yes, personally, well, you can never know for sure, but we are very confident that they will go up. And we spoke about it earlier. There's just going to be a higher demand for rentals because there's probably going to be less rentals. And yeah, the fact that the government thinks it's going to go up by $2 a week is just baloney.
Yeah. Last one for you. Is an SMSF now the best way to invest in property?
It's up there. It's up there. The government definitely incentivizes it. If you have the ability to do it
Yep.
for sure. You just got to make sure that the asset that you're buying actually is suitable for the plan of an SMSF. I know you touched on it. Set and forget is more what you want to go for.
Yeah.
Cool. I got a couple for you, big dog.
Cool.
In 10 words or less, what does this budget mean for property investors?
Inequality for young investors trying to get ahead.
Nice. I like that. Will these changes actually make housing more affordable, or is it just a political spin?
No, it's not going to make property more affordable, because if you look at the affordable markets, it's always going to come back to what can you build a new property for? That's always going to have the bottom end of the market, right? So unless you change what it costs to build a new property, you're not going to change the affordability, especially with the supply shortage that we're in as a nation.
Okay, nice. With negative gearing gone on established properties, what tax advantages do investors actually have left?
Well, as far as tax advantages, there's not really any, so to speak. This is why SMSF is now a more enticing strategy. But the thing is, if we're working towards getting a property cash flow positive and paying for itself, we don't need any tax advantages because we've got an asset that is paying for itself and we're also getting capital growth at the same time.
That's a great point, and we could probably do a whole video on what I'm about to say. But Australia has been under this fugazi. It's been under this mind enchantment that negative gearing is the be all and end all. I think that's going to change now. It's never has been. Positively gearing is the way to go, and we probably should do a video on that one day.
Definitely.
All right. I've got another one for you. What is the difference between drawing down on equity versus selling, and why does it matter more now?
So the difference between drawing down on equity and selling is when you draw down on equity, you're basically just taking a loan from growth that you've had in a property. This isn't a taxable event, but you do have to pay interest.
Okay.
Whereas when you sell, this is a taxable event, and you'll be taxed at the new rates that the government have now brought in. And this matters more now because they have increased the amount of tax that you're likely to pay on the sale of the property. Whereas before you would have got a decent 50% discount, you're not going to get it. So now it's a lot more attractive for certain investors to pay some interest on an equity release rather than realizing that profit and paying a substantial amount in tax.
Yep, great point. And last but not least, is the average tradie better off putting their next dollar into property or their super given these changes?
I think there's a really important nuance with this because personally, I don't love SMSF with where I'm at with my age. I don't want to wait till I'm 65 to get access to my money. Where I would say this is really a good strategy is if you're close to being able to purchase a property and SMSF and you might already have an asset in your personal name, the strategy of then deciding to top up your SMSF to get that property a little bit quicker in super, I think is a really good strategy. If you're just looking to buy one or two investments, again, this is a really good way to get some better tax breaks in the future. But guys, keep in mind, SMSF is going to be locked into retirement. If you have plans on retiring at 50, then you've got 15 years where you have to sit around and wait.
Yeah, cool. All right, sick. That's the last question, man.
Beautiful. I think we covered everything. If you guys have any questions, feel free to reach out to us at the Property Tradies on Instagram. And thanks for tuning in.
Yeah, appreciate it, guys.
Catch you on the next one.